All right. How do we get rid of this? Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and all orders are discussed are tracked and monitored. Virtual trading accounts, virtual account prices, and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in today's webinar, website, promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics lists for standardized options. PSW provides education and training services meant to teach curious and potential rewards for trading options. We are not a service tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing the webinar, you agree to hold the above harmless and any losses you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list to receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, now on with the show. What is going on? Well, we've got the Fed coming up in 40 minutes. That's the most important thing of the day. I mean, so many people think, okay, let's look at that. I think so many people think now, and I want to see if there's a number associated with it. Twitter. There, Twitter. Twitter app, scary enough, Twitter is like one of the best places to find out real fast information, better than Google. Fed rate cut odds. Latest. Okay, so 73% on a 25% base cut. A deeper cut is by, all right, so about a quarter of the people think there's, everybody 100% think there's going to be some cut. If there's zero cut, it'll be a shocker. Oh, what's this thing? At least two, at least three. That's how many cuts are coming over time, I guess. But you see how Twitter is? It's like, because it you know, you can do the word search with Twitter the same way you do with Google, but instead of the news, it brings you up whoever wrote the latest articles. And then well, you have to, it helps if you're like a geek like me, but I know that Bravo Trader is somebody reliable. I don't know Kevin Kelly. I've just seen like a good chart. But I know Bravo Trader is somebody, if they say that's the poll, and that's the poll. They're not just like bullshitting. And you don't get as much bullshit in finance as you do in politics anyway. When it's politics, you have no idea whether it's true or not. But with finance, you get a pretty good idea. Let's see what these guys say. Oh, they're talking about the odds of a recession. Anyway, so it's fun because that's how I can, you can quickly find out like something factual in Twitter scarily faster than Google, because Google will give you like too many news articles where they talk about something without just giving you the goddamn answer, which is kind of annoying. Anyway, so we're waiting on the Fed. We do have the EIA, and we already know that. And that was, let's make sure it's the right one. This looks like last week's. Isn't that weird? I guess it was the same 17 million because it's still July 26th. There's no change from the last statement, which said 17 million to this one. So refinery inputs haven't changed at all. We did have a drawdown, but now let's see if it's anything weird about the drawdown. Control plus. Make it nice and big for people. So we had a 8.5 million barrel headline decrease in crude. Gasoline decrease. This is the first time we've had this in a long time. Oil went down, gasoline went down, and distillates went down also. So everything pulled, and it's a big pull total. It's 8.5, 9, 10.5, like 11 something, million barrels. Call it 11.5 million barrels of draw. Even in the total here, you're seeing 53 to 43. So you got a solid 10 million. There's no shenanigans going on. Exports were basically the same as they were last month, so that didn't change. So there's nothing here really that had any major changes. This went from 21 to 21.1. So nothing here changed. It just was a very large demand drawdown in oil. Very interesting. Now, there's reasons it can fluctuate from time to time, and I'm not going to pretend I know why, but that's a big change. I mean, we haven't had a serious solid draw in oil in a very long time. We didn't get a huge reaction out of it, interestingly enough. We're up at 58.50, but that's nothing, because if you think about where were we? If you think about where I know I want to say it, but I want to check my facts before I say it. So if you think about where we were over 60 at the beginning of July, right? So we're in way better drawdown shape than we were. Oh, here's another thing you can do on the EIA. This is a petroleum status report, but now we can go for energy storage. Oh, it's so hard to figure this stuff out. Sources and uses. Petroleum, this week in petroleum. I want to say that's where it is. So let's look at this week in petroleum. Retail prices, future prices, cash flow statement items for oil producers. That is so interesting. Wow. This is a really good preview of whether OIH should be doing good. This is the cash flow of oil producers, and the cash flow is actually dripping down a bit from last year. That's not good. You don't want to see that. That's not good for OIH. Well, it depends how you're betting. We're betting bullish on OIH. Cash flow statements, sources of cash, uses of cash. So obviously, we got some problems. Oh, and here you go, right here, capital expenditures. So less capital expenditure, less capital expenditure. That's not good. This is what I was actually looking for. But anyway, I don't want to jump around too much. I don't want to jump around. That's a funny statement for me to make. I am aware I skip topics a lot. This is why I have so many screens in my house, because I'm just I pay attention to lots of things at once. I'm a huge multitasker, and I know people, don't keep up. So sometimes it's good to push me back on track. Anyway, so OIH, although it is picking up a little bit, though, these trends that we're seeing in the EIA report are not good. And you never know what they're going to talk about in the EIA report. The EIA report is kind of like Phil Stockwell. It's it doesn't really, it talks about what the guys think are important. Whoever authors these reports, it's what they think is important to discuss in this petroleum report, in this week's report. It randomly, though, there's no set thing. It's not always this. I haven't seen this cash flow thing in ages and ages, and it's so freaking useful. This is incredibly useful if you're going to be playing OIH to try to get an idea of what's going on. And look at this. You can see all of 2019, way less money is being put towards capital expenditures. And that's what OIH is, capital expenditures for the oil companies. So that's a pretty big problem, unfortunately. Why do these all have different dates? Oh, these are all capital expenditures. So better than last year, but not better. But my logic with OIH is that we're in the bottom of the cycle. I really felt like last year was the bottom of the cycle. So we're betting long-term bullish on capital expenditures. So I expect next year should be better, and next year should be better after that. So we'll see. But it is a long-term play, and I'll see if I can find it. I don't know which portfolios I have in it, frankly. Ken Boca took a big hit. I think in the butterfly portfolio, we have an aggressive play on OIH. Yeah, that's pretty aggressive. So we have, we only have 50 short calls. We have 100 longs, and we're deep in the hole here, but it's a long-term 2021. We have the 15 calls. We're at 15. And so what we're looking for is over the next year or so, we're looking for a nice pickup in capital spending. We want to keep an eye on it, but the trends are so far not confirming our premise. We want to see more spending on oil. I just can't see, though. Here's the thing. Logically, the lifespan of wells is about 3 years, okay? So here they spent a lot of, well, not here, sorry. So they were spending, before 2016, they were spending a good amount of money on wells. And if we look at Yahoo, hopefully we can figure that out. Let's look at Yahoo and go OIH, because we need a long-term chart. And we'll look at this chart. I don't want to look at that many years. 5 years. Okay. So anyway, so it'd be nice if they had 10 years. So basically 2012, 2014, there was a bit better spending cycle, right? And even here it went, but since last year it's just been down and down and down, and there's been less money put towards exploration and production. Part of that is that they built up all that shale drilling, and then that you know, at a certain point you expand into the shale, and there's not much room more to go, so they stop all the building, whatever. There should be a pipeline stage, but the pipelines are being held up by, you know, the government and protests and all this stuff. But the bottom line is that they went through a spending cycle before this. There hasn't been that much since, and we hit a real trough here. But since the lifespan of wells is 3 years generally before they really start trailing off in productions, after 3 years, you generally have used up 50% of a well's capacity. And from then on, it's just going to like spit out less and less and less oil all the time until it's drained. So 3 years is a peak capacity for wells. So by 3 years, you have to start drilling new wells if you want to keep your overall production levels up. And so you've got to put that money back into E&P. This reflects a long time of not spending money, at which point you expect it to improve. So over the next 3 years, we should see this cycle back up, almost back to a positive. I'm sorry, certainly back to a positive. It may actually look like a pretty abrupt shift. The thing is, though, clearly on a quarterly basis, we're not seeing that yet. So Q1 was still down. That's very upsetting. All right, so we want to see much better numbers there. All right, getting back to the main topic, unless there's something else cool to look at, shareholder distributions. No, we don't care about that. Wow, look how much money, though. Look where the money is going. They are sending it all back to their shareholders. That's annoying. That means also the distributions will go down. That'll be bad, too. All right. Meanwhile, this is what I was trying to look at, though. We are having, you know, the last couple of weeks, we now have a pretty good drawdown, and this probably doesn't include. Is there a date? There's no date. This, I would say, this June 19th. Well, that doesn't prove anything. That's December. I'm going to say this does not include this week's drawdown. So we're pulling down this line already, like 420. Oh, I'm sorry. There's a number. You don't have to guess. There's actually a number in the EIA report if I could find it. This is the EIA report. Okay, stupid. Anyway, whatever the number is, we're getting back to a normal position in the 5-year range. And if we're getting back to a normal amount of supply of oil in the 5-year range, and we're no longer building our stocks, then you might expect the price of oil to settle back into a 5-year range. Oh, meanwhile, I was going to get the exact numbers. So this looks like 420 to 60, 440. And the actual stock number before we left that page. It's only looking at the actual oil number, 436. So it hasn't. So that's just looking at the oil, not the total supplies. But so basically, we're still in that same range on that chart. It's not that big of a difference because it's only looking at the oil. It's not showing a $10 million drop. But like I said, though, so basically we're coming back to the middle of normalization of the 5-year range. So then you say, well, geez, wouldn't that make sense? Then oil prices are probably going to normalize somewhere in the middle of a 5-year range. So now let's see what the 5-year range is. And we go weekly and we look 5 years back. And I guess a purist would say you got to go back to here, but let's ignore that because that doesn't look normal. And that means the 5-year range is right where we are. Look at that. See, so there's nothing to get excited about so far because we're only back supply-wise and storage-wise, we're back here. So people may speculate higher, but we'd have to see a lot better evidence of that than what we've got so far. Yeah. All right, what's next? So on the whole, here's the funny thing though, because last year, oil was $68, and now it's 56. It's so far below last year. I still would think, I tend to think it's going to go a bit higher based on this report and last week's report. It seems a little low. If you have any questions from this. No questions. Everybody's fascinated by what I'm saying and has no questions. Great. You guys are giving me a real inflated sense of self-worth or whatever, which I just read is bad for you. I couldn't believe that. I don't know if I shared that with the class. I think I did. What was that article? I don't know if it came out in today's thing, but I'm trying to remember exactly what it said. What is that? This is not today. Wait, I had a Fred Flintstone picture today? That doesn't make any sense. Oh, I didn't realize. Wayne Walker put it in. I didn't realize. How do you figure that out? You're not supposed to be able to do that. Wayne, you got to tell me how you did that. I didn't know members could put in a picture. That's weird. I thought that was administrators only. Your performance goes up when you do this one thing. No, I didn't, because I didn't think it was right. Anyway, it said that you will perform better if you don't think of yourself as being the center of attention. And I think that only applies to people who have anxieties about being the center of attention. I'm used to being the center of attention. I mean, I'm not egotistical. I mean, I'm the guy that people ask questions of in these webinars. I'm the guy who's at the head of the podium when I'm doing these lectures. I'm the guy teaching a class. I'm the guy who's being talked to on the TV. So I mean, I am the guy who people are paying attention to. It's not my ego. It's like I know that's me, and I don't have performance anxiety from that. I don't think that people say that people who think that they're the center of attention. I guess this means in normal situations, like in normal social situations and things, where frankly I don't like being the center of attention. But in normal social situations, people have a performance anxiety or whatever they have. I can't relate to this because I'm extremely, outgoing. I was thinking about that because my daughter Jackie's like that too. She's very, she is the one that's always talking and yapping and getting involved in things. But they say that people, which I guess is average people who have fear of public speaking and stuff, who want to perform better in these situations should not think of themselves as being that important. They should think of themselves, and realistically too, in the grand scheme of things. I mean, I get up and do a lecture or give a seminar, a proper seminar, like really on a podium or whatever, and I'm not the most important person in the room. There are other important people listening to me. There is whatever. There are other important people who are going to speak and so on and so forth. So if I wanted to psych myself down, I could say, I'm no big deal. I'm just one of the guys giving a lecture or whatever. But I don't know, when you stand there, you feel like the center of attention. I think it's kind of hard not to feel like the center of attention. But they say that trying to put yourself in some kind of a perspective that you don't feel that every move you make is being scrutinized and whatever. But I think I didn't post it for that reason. I disagreed with the premise because I said, well, that's only for people who have that kind of anxiety. But now that I'm sitting here thinking about it, I guess that's most people. I think most people are not comfortable jumping up in front of a podium and telling a room full of 1,000 people, how to do something. Because they're like, well, who am I to be saying this? I think most people have those insecurities. Whereas I guess I did once upon a time, maybe, but I mean, I've been teaching for 20 years, so I mean, it's at a certain point, you say, well, I teach enough people where I know that if I tell people this is how you do something, that it's a good way to do it. Based on trial and error over many, many years, I do know that this is a good system. So anyway, what else have we been doing today? We haven't done much exciting. We've just been waiting for the Fed, which is 20 more minutes. And there hasn't been too much going on. NAK, oh, they came down a bit. This is weird. NAK yesterday, they had this news where the EPA is going to waive their problem, but it's still not a go-ahead. They still have to go through a process. But at the moment, NAK is waiving their concerns. And the stock, they're on a path where they may get an approval. They get approval to strip mine Alaska. This is the largest untapped gold mine in the world. No. If you think everyone knows the gold is there, it's just been environmentally impossible to go to mine it. So I just took a big, Trump has been stripping down all the environmental regulations and depowering the EPA. The bottom line is where they're going to mine is remote, but the runoff from the mine, the poisonous, the waters and the dirt and the sewage and all that, and the waste from the mining is going to, this is what the EPA decided, it's going to run into the water where the salmon, like the major Alaskan salmon, go upstream. So basically, their stupid mine can wipe out the entire salmon industry in Alaska. If there's a spill or if there's something else, you can kill it. If you kill all these salmon, you can't just get new ones. These are the ones that live there. So if you have a spill during spawning season and their population is significantly reduced, you can completely wipe out the salmon industry, which is a huge industry for a lot of people out there. That's why the mine never got a permit. Now, NAK has put forward several plans saying, oh, that's never going to happen because we're going to do this and we're going to do that and we're going to put a pipe here to make sure, blah, 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 blah. But that's, it's the same thing as somebody assuring you your basement is never going to have a leak because they did this and that. It's like, sure, you did this and that, but you never thought there'd be this kind of storm and all of a sudden, boom, it leaks or the pipe bursts or cracks or something goes wrong. And if it's your basement, you can live with the odds that the worst thing that's going to happen is you're going to have $20,000 worth of damage in your basement. On the other hand, when it's the entire salmon population of Alaska, it might be a chance it's not worth taking, just like nuclear plants. It's the same thing. It's like, why don't we put a nuclear plant in New York City and then it could feed everybody directly in New York City and we'd have less blackouts? Well, that's because it would be extremely super bad if it failed. We would destroy New York City the way Chernobyl has been destroyed. What are the odds? The odds are very low. But the odds are very low that we could actually destroy New York City. Even a 1 in a billion shot that we destroy New York City, it's not worth taking the chance. Don't do anything that could destroy New York City. I mean, can you imagine disaster movies? Follow that advice, there would be no disaster movies. Just don't do things that destroy New York City. Don't zap Godzilla with electricity. He might destroy the city. I don't care how remote the possibility is. It's like, don't do it. All the stupid crap that happens in these movies, like, well, you know what? Don't even do it. It's the negative possibility is horrendous. So don't do it. That's what this is. It's not that it's likely that NAK is going to kill all the salmon. It's just possible that they'll kill all the salmon. So given that it's possible they'll kill all the salmon, and there's not a life and death need for more gold in the world, that the risk, the reward of getting more gold doesn't justify the risk of killing all the salmon. They're irreplaceable. It's a simple concept, and that's why they've never gotten this permit. We got interested in NAK because we saw that the EPA was being eroded by Republicans over time, and we said it was a gamble. We said if there's ever a Republican president gets into power, they'll defang these regulations, and these guys are going to push and push and push, and they'll pay off as many judges as it takes for as long as it takes until they get the right judge and the right senator and the right Congress, and eventually they'll get it through. And it's been years. They've been at this for like 15 years trying to get this thing approved, and we've been playing them for a couple of years now. But given that, especially after Trump got elected, we got kind of gung-ho bullish on these guys, and it's still taking forever. It's still not going through. But again, because there's so many people who can make very logical arguments to the judges and officials and whoever that's up there and say, no, this is not something you want to risk. And even Republicans in Alaska, they've got a lot of interest in the fishing industry. So they're not even 100% behind this thing. That's the trick to this whole play. But if it ever gets approved, and I still think it will, because again, the argument is, oh, it's a 1 in 10,000, 1 in 100,000 chance that we're gonna that our protection system is going to break down and it'll poison the water, and it'll poison the water at the same time the salmon happen to be coming up the stream, and they'll all get poisoned and die, and that'll be the end of the salmon. The chance of that all happening together is very slim. So, they can make an argument until they find a friendly judge who goes, yeah, that's such a remote possibility. I'm not going to, we're not going to stop capitalism over that, right? You can't do that. Let's start thinking, you can't stop capitalism. That's pretty much the rally cry these days. So that's the whole premise behind this thing, and maybe it'll work and maybe it won't, but this is exactly the kind of penny stocks I love to put in my kids' accounts. My kids have accounts that are full of little penny stocks that I like to play with. Not full, but I mean, they got, they have probably half dozen of them. Because in addition to nice, normal dividend paying stocks that they're going to have for their entire lives, I like to have some speculative gambles, because they can afford to put a few $1,000s into NAK, and a few $1,000s into liquid metal, and a few $1,000s into who else have we been playing? I forgot. It doesn't matter. Oh, the Maven. These are things that may be 10 baggers down the road. So if they get 50, if they get 20,000 a year, 30,000 a year, 40,000 a year, it boosts their lifetime savings. If that happens over the next 10 years and they get a 10 bagger and they jump up to 20, 30, $40,000 on a single stock in their portfolio, that sets them on a road where they'll have another $1 million, $2 million into retirement. So the risk of that, the reward of that versus the risk of losing a couple of $1,000s now is a fair play for the kids. It's these kind of, there is an appropriate place to do some gambling. So occasionally it's fun to have some place like this. Natural gas did a big pop today. That was nice. We've been playing this, and it's very frustrating. It's been down, 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 and it finally popped us back up. Well, I think we started at 220. So, and actually we're at, I think it was like 240 or something like that, or 250 in the, I think we're at NGN 20. Well, actually, I can look around. So trade, active traders, NGZ 19. So we had some of those. We got the NG N20s, I think, were the most recent ones we were looking at. Yeah, and they've come up a bit. Is it NGN, NGZ20? That's the ones I was thinking of. So the NGZ20s were down very low, like 260s, and they're at 270 now. So all of them came up about 10 cents though. So that just basically put us back on track. So, and of course, what you do is when you get back on track after you double down, you get half out, and then you ride the rest out with a lower basis. That's all. The idea, you don't get greedy and try to win huge. That's a terrible idea, because it could come right back down tomorrow. We don't know. There's no really good reason it went up. And of course, with natural gas, the premise is that over time we're exporting more and more natural gas, and that's going to put a constant downward pressure on our total inventories of natural gas. Oh, in fact, back to the EIA, right? So now we go to the EIA, and we get back to the main page. And instead of looking at the petroleum, we go to natural gas, and hopefully they have a storage thing. Oh yeah, look at that. So here's the storage. And you see how the storage, last year we slipped very low in the 5-year band. All right, but let's see, we are in July. So last July, we were here. So we're actually higher in the band than we were last year. Or that's not really fair, because the band has moved, because here we are in the same place, right? So right here, we were here, and now we're here. So we've only gone up about a couple 100,000, a couple 100 million cubic feet, which sounds like a lot, but it's only the difference between, it's not even 10% more. So it's just a natural fluctuation. What's happened is more storage came online. Here, more exports went online, and we had a big drain last year, and then storage started catching up. So I'm sorry, not storage. More exports by LNG terminals caused a pull in natural gas. The next thing that happens, though, is more natural gas production comes online because they want to meet this demand. And then for a while, you have a little bit too much gas, and you start building up again. And this is normal seasonal. I mean, building up as in getting closer to the middle of the band as opposed to being below or outside the band. So this is the build. The build isn't getting to this line or anything like that. You look at this band, which is your 5-year band. Here we went below the 5-year band because LNG first got turned on around here. And two things happen when they build an LNG export terminal. Before they start exporting the gas, they start buying the gas and compressing it, because LNG, liquefied natural gas, is 600 times compressed natural gas. So in other words, they're going to take 600 tankers of natural gas on a train and compress it into one tanker. Just think of it that way. 600 tankers of natural gas come from train. They have to truck them in or train them in or whatever they do, or via pipeline. Doesn't matter, however you want to think about it. But 600 big giant, the scary things on the highway of natural gas get compressed into one incredibly scary tanker of liquefied natural gas. So that by itself creates a demand, right? Because they're not going to export. Now think about it, they're not exporting one tanker of natural gas. It's, even though it's got 600 in it, it's still only one tanker. So they're going to want to put on a boat the normal 50 or whatever it is tankers full of natural gas that they put on. So it's 50, but now it's 50 times 600. So now one boat is going to take 3,000 tankers of natural gas out of the country. All right, that's what it is. So there's a buildup at the plants also that causes a big draw, because every time they put a new plant online and a new processing facility, they start compressing and compressing and compressing the gas, and they got to buy more and more and more and more gas until they fill up their own liquid natural gas storage vault, or whatever you want to call it. Liquid natural gas tanks, I guess they would be. They've got to fill those up, and then the export boats start moving. Once these are filled, and they've got a system where they can bring in enough gas to refill it, and then a boat takes them out, and they take it and they send it out, and then they bring in more gas and compress it. It becomes finally a system that smooths out. But because of this incredibly complicated process and the differences in the size and all that, you get some wild fluctuations, and we will for years to come. We're going to get wild fluctuations in inventory, because first there'll be too much use. First, there'll be too much exported, then there'll be too much produced in America, then there'll be more exported, and suddenly there'll be a big drain again. So this is going to go on for a long time. But I think overall that we're going to stay in the lower end of the range, and we're going to slide back under in probably towards it's certainly by next year, we're going to slide way under. We're going to look like this again, and natural gas prices will spike up. And let's see if we can get a visual on that. Here's natural gas, and here's last fall. Look what happened. Okay, that is this. Because everybody overreacts to everything. Because here they're like, oh my God, we're running out of natural gas and blah, blah, blah. And here's like, oh my God, look how much natural gas there is. This is crazy how much natural gas they're producing. That's because last year people were getting $4.50 for natural gas for 3 months. That's like daily. No, 2 months. All right, so for 2 months, basically, people were getting $4.50 plus for natural gas. They were getting $4 plus for 2 solid months. For 3 months, they were getting $3.50 in that range. That's That's a jackpot. So a whole bunch of people run to the market and say, oh, I want to get into this business, or let's put some money in shale and blah, blah, blah. And you're doing it too. When you're the natural gas investor and you start plowing money into these companies, you're saying, yeah, I want to bet on natural gas next year. Well, what does that do? That causes more production. And then all of a sudden, boom, prices collapse. Because now there's too much production and we exceeded the ramp up in exports. But then the ramp up in exports is going to catch up to us and this will happen again. So my concept with natural gas, I just want to always have a long, you work it in and out and you do whatever you can to try to keep it in place, but you want to always have some longs just in case it ever has a big pop. Because these pops, a penny move in natural gas is it $100 or $1,000? I forgot. Well, whatever, it's a lot of money. So when you have a $1.50 move here, at $100 a penny, that's $15,000. Yeah, that's about right. So this is a $15,000 per contract gain. So I want to be in it for that. I want to be here for that. So I'm going to try to maintain always a couple of longs. And what happens is you have a couple of longs, and then if it goes too far down, you buy more. Then if it goes too far, then if it goes back up, you sell. I just said that today to everybody. I said, make sure you sell, because if you bought more and double down here to get your average down to 225, then you damn well should be selling at 225. You can get back to, so if you have too long here at 240, and then you double down at like 220, and you average 230, then it goes up to 230, and you get out too. So now you have a 230 average. Then it goes down to 220 again. You double down. Now your 230 becomes 225. Goes up here. You get out half again, with a little bit of a profit. Now your average is maybe two on the ones that you have left. You have a couple left at 220, 230, maybe 220, 225. At 225, you're in. Then it comes down to 215. Double down again. Your average is 220. It comes back over 220. You get back down to 2 again. A number you're very comfortable with that you can double down whenever it goes down, and then you're ready. Okay. Oh, Fed time. Holy cow, it's Fed time. All right. So I hope that was clear to everybody. Let's see, question. Any BDCs you recommend for yield, or are we too close to cycling into a recession to make BDCs a good idea at this time? I don't usually watch those, so I tell you what though, if we talk about this in chat, JC, he's asking if any BDCs that I recommend, like AINV, SAR, or PNNT. We don't really watch them that closely, so I think we're going to have to look at these a little more closely in chat. Remind me though, I don't copy these, and I don't have a copy of these afterwards, so you're going to have to remind me about the question, but I'll be happy to discuss it in the chat room later. One thing that improves performance. One thing that improves performance article was in Tuesday's chat, added Wednesday morning. Oh, okay, thanks, Eric. I knew thank you. So it was in chat, that thing. The way to be self-aware. All right, so Eric says that in the end of Tuesday's chat, early this morning, I did put that in the article. So that's what happened. All right, anyway, back to the Fed. What is the Fed doing? Let's take a look. They have a very short statement, so now we can find that. Here's the Fed. Oh, what did I just do? This is what? This is not their statement. These are the minutes. So we want to go to this thing, and we want to see if we have their statement for June, July, any minute now. Dun, 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 dun. And where's the market? We are, let's watch these charts. We're up 20 on the Dow, 3 on the S&P, 10 on the NASDAQ, 11 on the Russell. And let's see what happens. Waiting the Fed, waiting the Fed, waiting the Fed. Wait. Here it is. Quarter point cut. Disappointment. All right. Ending their balance sheet reduction. That's actually bullish because they're cutting back on what they're no longer reducing the balance sheet. But It doesn't matter. The expectations were too high, a quarter point cut, disappointing. All right. The balance sheet reduction though should balance this off. I'm not expecting too much of a sell-off. I think the gut reaction is these are the people who are disappointed it was only a quarter point cut. We shouldn't have any cut. We should be raising rates. This is all insane. Because the Fed disappointed, look at the dollar. The dollar's popping 98. Hasn't been over 98 in ages. That's putting pressure on everything too. So this will be interesting. We'll see where we settle off. This would be a really poor reason for the market to tank. But the market could tank for no reason at all because it's so overpriced. So the Fed starts unwinding their balance sheet. That's important too because that was effectively a hawkish move, unwinding their balance sheet. Holy shit, look at this reaction. Wow. You can still short the Russell because we were shorting 1595 is better than where we were shorting it this morning. So if the Russell starts following everyone down, you can get a pretty violent move down here on the Russell. The strong dollar is good for the Russell, but the dollar may weaken after this because this is pretty high. Rosengren and George voted against it. Two people voted against this. Hang on, let's take a look at the actual statement. This is it, right? Information received since the Fed June indicates the labor market remains strong, economic activity rising, job gains are solid, unemployment remain low, growth of household spending has picked up, although, when you start with although, you gotta be careful. Although growth of household spending has picked up from early in the year, growth of business fixed investment has been soft. On a 12-month basis, overall inflation for items other than food or energy is running below 2%. Market-based measures of inflation remain low. Survey measures of long-term inflation expectations a little change. Consistent with mandate, the committee seeks to foster maximum employment price stability in light of implications of global developments for economic outlook, muted inflation pressures. So, in light of implications of global developments for the economic outlook, in other words, no trade deal with China still, I have some lunch while I'm doing this. Committee decided to lower target by a little bit. This action supports the committee's view. And by the way, 2 to 2.25% is way higher than the rest of the world. So we are high for rates, but we should be. This action supports the committee's view of sustained expansion of economic activity and inflation. The other committees, and now when they say symmetric, what they're saying is if it goes above 2%, they're going to be just as quick to try to get it back down also. Uncertainties about this outlook remain. As the committee contemplates the future path of target rates for the funds, it will continue to monitor the implications of incoming information and will act as appropriate to sustain expansion with strong labor market. Inflation is symmetric. They say symmetric a lot, so they really trying to say they're being very data dependent here. In determining the time and size of future adjustments to the target range of federal funds rate, the committee will assess realized and expected economic conditions relative to its maximum employment objective and symmetric 2% inflation objective. The assessment will take into account a wide range of information, including measures for labor market conditions, indicators of inflation pressures, expectations, reading on international dollars. Okay, great. All right, well, how fun for them. So, not a big deal at all. Now, another nice thing about Twitter is they have the FOMC. Somebody's going to have the statement compared to the last statement, probably by now. Yeah, just find it, please. Twitter, what are you doing? What's going on here? Oh, is it already on FOMC? Is that why? No. Go ahead. What are you doing? No, see, that's FOMC. It's a different category, you dumbasses. Ugh, I don't like the new Twitter at all. It's so confusing. Where's the search? Okay, FOMC, correct. Latest. There. The only way to find it. All right, so what's the big changes? Economic activity is rising, and they say has been rising, so they think that economic activity is slowing. Household spending appears to have picked up, has picked up. Indicators of business investment have been soft, and now what they're changing to say is growth of business investment has been soft. Really? Where's the distinction in that? Market-based measures of inflation compensation says have declined, and now it says remain low. So this is what changed in a month. So they had declined, and now they're not coming back, and they're not happy about that. Consistent with the mandate, blah, blah, blah. Okay, in support of, and the change in light of, oh wait, it's a big change here. In support of these goals, the committee decided to maintain. So that was last month. Now they're saying in light of implications of global developments of economic outlook and muted pressure, so that's what they feel is changing. That the global developments of the economic outlook, which is true because a lot of the world economies have been reporting poorly, as I noted this morning. So global GDP is down, and they're worried about that. I don't know why it's our responsibility to save the planet, but apparently it is. So they see muted outlook, and inflation pressure is just, there's no inflation pressure at all, really. The committee contemplates the future path of Fed funds rate, blah, blah, blah. The committee will conclude, that's a completely new concept. The committee will conclude the reduction, and this is what I mean, this is what's going to stop it from going down too much. This is a very stimulative thing, that they are no longer reducing their balance sheet. Reducing their balance sheet was something that was putting pressure on the market, and we knew that was going to happen. So that should make it turn back up pretty quickly. And oh, and look at that. We've already turned back up pretty quickly. So it's coming in as a null event now. So at the moment, it's a null event. But the bottom line is, like I said this morning, it's not about, wow, look at the dollar still cranking up. It's not about whether the Fed tanks the market. It's whether the Fed can support the market at the level it's at these highs. Does this make enough of a difference that this is sustainable? And that's where I think we kind of run into trouble. I don't think this rally or this market top is sustainable without more stimulus than what the Fed's giving us. There's not enough outside support, and there's not enough internal cash flow, profit flow, market support to justify these prices, and to justify, it's not just the current prices and valuation, it's you're saying that the future is bright, we're going to earn more than that next year and more than that the year after that, and nothing bad could possibly happen, so there's no risk involved, and there's no inflation that's going to wash out our gains or anything else bad is going to happen. That's where you start getting into the unrealistic territory. So that's where I have a problem with this thing. So I don't think this is sustainable. So the Fed report itself, fairly neutral, but I don't think neutral is enough to sustain the market. But we're very adequately covered for that in our portfolio. So I'm not worried about it. I think this all plays out exactly where we thought it would. The Fed didn't say anything devastating, but it also didn't say anything reassuring. Well, I'm sure Trump's still going to say they didn't cut enough. But the reality is they cut too much, really. They shouldn't have cut it all. Because what they should have done 2 meetings ago was raise rates. And they should have said, economy's strong, everything's great, blah, blah, blah. If anything bad happens, we're ready to lower them, but for now we're raising. And they should have said, we are raising 3 times until we get to 3.5%. They should have kept raising. And if they did that, they'd have a ton of firepower if they needed it And also the good thing about that is you could have let the market correct, and it really needs a correction badly, and you could have blamed the market correction on the Fed instead of on weakness in earnings or whatever else, or international conditions or whatever. If you can blame the market's decline on the Fed, then people don't lose faith in the market. They say, oh, that's stupid Fed, and they'll keep buying stocks. But if the Fed is helping the market and the market declines anyway, then people start blaming the global economy and the internal earnings power and so on and so forth, and people lose faith in stocks and they don't go rushing back in. That's worse. Okay, it's like Batman. Sometimes you gotta be the bad guy, right? No, that's one of those Batman movies where he had to, like, pretend he killed those cops. It's not, you've got to be the bad guy. You've got to give them a villain, and the Fed has to give them a villain, and they're not doing that. Trump didn't let them do that. He made them a villain when they weren't, and now they're not being the villain when they need to be, because this market will correct, and it needs to. And when it corrects, if it corrects and people don't like the reasons, and they don't feel that now they have faith in the market anymore, that's how you end up with these incredibly huge troughs in the market, like we had in 2008, 9, whatever. It takes a long time to come back from that. The Fed does not have the kind of firepower they need to raise us from that kind of level. They can't cut that much because we're already way down in rates. So I'm not happy with the overall situation right now, but I haven't been for a while, so it doesn't matter, does it? I haven't been happy with the market for ages. We're reluctantly participating in this rally. So that's to take all these positions. These portfolios you have to take with a grain of salt. We've never touched money talk. That's always a good one to look at. Wow, 168%. That's crazy. So we didn't touch money talk, of course. That's a good indicator of where we are. The OOP is 255. That's probably not right, because I'm sure there's got to be some. See, like these expired calls. These need to be fixed. I just have not had time to update all these things. And the long-term portfolio, I'm pretty sure I did all the expiries in the long-term and short-term complete. So that's a pretty solid 218, which is crazy. So that's just under 16. And the short-term portfolio, hopefully it's up a bit today. Nope, 610, not very exciting. And that's 710. So still, that fills in the gap. So it's exactly 16 plus 7 is 23. We're right at 23. Basically, we were not moving. I mean, we just did our portfolio reviews the other day. Not the other day, but where are they? Go to the portfolio tab here. 20 what? Oh no, that's a mid-year review. Okay, I was gonna say there's no way, because I know we had more than that. Was it this weekend? There it is. Okay, so we had 2285, and now we have 2.3 million almost on the button. So we're at $15,000 since Friday on our combined portfolios. So we're perfectly positioned for what's going on. I mean, that's we're not touching anything. We're at $15,000 and into the uncertainty of the Fed, so that's fine. And we're going to make now that we're past the Fed. And as we get past earnings, we're going to be able to nudge our positions in various directions and see what's happening. Oh, here's a good one. Let's take a look in here. Let's take a look at Hemp Boca. We have, what's the guy who you just tapped? Molson Coors, TAP. Okay, so in the Hemp Boca portfolio, TAP was minus $300, right? This is before earnings. They're at $54. Now, today, in the Hemp Boca portfolio, TAP took a big hit. They went down to $52 since then. And now we're down about $1,000. We're actually probably $1,400. Okay, so we've lost about $1,000 on this position. All right, but that's not terrible, is it? Because we control 2,000 shares of TAP, and the stock went down from 54 whenever we did this review, which was don't know what day we did that review, but whatever day we did that review, probably about a week ago. And now the stock is 52. So the stock's only down $1 since we last looked at it, and it cost us $1,000. So our delta on the stock must be 50 cents. Our net delta of this position is about 50 cents. So we make about 50 cents per dollar it goes up, lose about 50 cents per dollar it goes down on 2,000 shares. So it's not devastating. People are asking me, should we adjust it and blah, blah, blah. And I'm like, it's really not that big a deal. You know, despite the very large, what is it, a $4 drop today? Despite the $4 drop today, which is like 8% of the stock price, it didn't really hurt us that bad. Because we're in a good, solid position. Our short puts are 47.50s. We're nowhere near 47.50. You know, yeah, we're now losing money on our short puts, but we're nowhere near 47.50. And when these things calm down, as long as we hold $50, these are going to go right back to losing their premium again. All right. As to the bull call spread, yeah, now we're low in the channel on the bull call spread. We want it to be at least 55, but we only paid 17 minus 12 is like $5,000, right? So we paid less than $5,000 for this, 47.50 to be exact, which means that at anything over $2, which is $4,000, we're pretty much profitable. Okay, so anything over 52 is profit for this position. So we're not in a hurry, and we're not in a panic, and there's no big deal on this position. Unfortunately, we had a bad earnings. We were hoping we'd have a good earnings. We did not, but it hasn't blown out of what we expected. And that means that there's no reason for us to rush to make an adjustment. MJ is steadying up, but disappointing at 28. Macy's is coming back strong. IMAX doing phenomenal. So we have two good performers and two bad performers. Our bad performers aren't killing us, but on the whole, portfolio ends up being flat now, where we were up 6% at the high. I think going into the weekend, we were up like 6% in this portfolio. So we got hit pretty hard. And it's here though. And obviously, because in this portfolio, it's only a $50,000 portfolio. It doesn't take much to throw the value off. But it is a small portfolio. We don't have that much buying power. We haven't used much of it yet, but we're not going to throw it back into a position we already have that isn't really off track. TAP. So the question is, and as I noted, these guys are still going to make $6 a share, or $4. Wait, 150. They're going to make $4 a share at least, and $4 in a $52 stock. As I mentioned earlier when we were talking about when it was down here, I said 52 is a solid floor. They're going to make $4. Then 52 is 12 times earnings, 13 times earnings. Okay, so it's crazy to think they're going to be less than that. That's a price you buy the whole company for. I mean, somebody making $4 a share on a $52 stock. You want that stock. And we looked at the earnings. We said it wasn't that terrible. It was certainly not so terrible that it merits a 7%, 8% drop that we had earlier. We bought them because they were low. That's why we bought them. We bought them because they're going through a rough patch. We buy a lot of things because they're going through rough patches. So we bought these guys on 618, and on 618, they were here. And where are they now? They're back to where they were on 618. At the moment, though, because of the quick drop, the premiums are excited. The premiums are higher than they were when we bought them, so we're suffering. But there's nothing wrong with our position. So that's first. So the funny thing is that's caused a 2.5% drop in the portfolio by itself, and or more than that, because we were positive and now we're negative. But either way, it's like, let's say 3% drop in the portfolio is due to this one position, and all it has to do is stabilize here, and we're going to be right back in the money. All right, and our goal is 60. Okay, over the next 18 months, we need to get back to there. And $4 a share times 15 is 60. So I don't see any particular reason we can't get back to that. Even if they don't improve their EPS, all it's going to take is for sentiment change in the sector to say, okay, you know what, a big beer company like this is 15 times earnings. And the reason we got into them is because they spent a lot of money buying, forming a partnership with a cannabis company to make cannabis beer, which is probably going to be a hot product. If not, at least CBD beers, even if it's not, even then we'll go full cannabis, they'll still do CBD beers, and that'll be a big market. And and there's another, and they've done a couple of things to expand. So they're aggressive, they're spending money, and they're looking to expand. They're not sitting on their laurels. But unfortunately, you know, when you've got a steady, solid company like this that chugs along, and they start spending money to expand, and then that money, then internally they have strife trying to get it all lined up again and get on track. People don't like that, and people who've held the stock for many, many years can tend to dump out. But this is deservedly a $70, $80 company, and right now it's trading not even, you know, barely holding 50. So I do like them long term. I like the trade we have, and I've got no reason to change it in any direction. I wouldn't even sell calls against it because it's too, I think it's too undervalued to sell calls against. Okay, let's see. 223 already. Wow, things are flying. How's the market doing? We're settling in a bit lower. People are selling. There's another chance to short at 1600. That's nice. I like that short. No, there's no reason oil or anything else will change. The dollar is still powering. Oh no, actually it settled down a bit. It hit that, but it's settling down a little bit. Natural gas is still way up today. Gasoline, normal. Gold is still pretty strong, especially with a strong dollar. It's a pretty good high. That's good for gold. Silver going up despite the strong dollar. Very interesting moves. Let's see what the news says. News. Stocks mixed after Fed cut. Okay, yeah, we can see that. Oh, sure you didn't want to touch an ad. China Southern, oh man, oh, poor Boeing. China Southern cancels remaining Boeing MAX planes. Canceled order for 64 planes. Oh man. Wow. North American construction, that's good for them. MicroStrategy, plus 13% is good for them. Nordstrom had, I can't believe Nordstrom has good sales. I go to Nordstrom, there's nobody there. So all the department stores went up because Nordstrom had good numbers. Fed cut rates, citing economic outlook, inflation. It also will conclude shrinking its balance sheet. That's exactly what the Fed Fund futures have been expecting. The Fed members voted against it. Okay, there's nothing we can say already. Okay, so that's no big deal. What's that? North American construction, don't care. Most of these don't care. Nordstrom. Oh, the family. Nordstrom spike jumping to the game. The Journal said they're readying a plan to boost its stake and strengthen the grip on the company. So they're taking it private, essentially. Yeah, if I were them, I'd be sick of that price also. I mean, I'm no fan of Nordstrom, but it's just all retail is just so ridiculously low. And I bet Nordstrom owns a bunch of their stores too. I don't know what their real estate situation is, but look at the P, 10, 11, it's like Macy's. I mean, I don't get Nordstrom's at all. I can't believe the prices of the stores, but look, you can't argue with this, right? $15 billion in sales, and they're making $500 million. And it's pretty consistent. We had about a year back here, but forget that. Whatever they made, whatever happened that they had to fix, they fixed it. They're back on the track, and they're at $564 million, and you can buy the entire company for $5 billion, just about 10 times earnings. That's a 10% return on capital. So you have a very wealthy family that owns a majority stake in the company, and they're like, you know what, for this kind of money, why would I own other stocks? They know their company, they understand their store, and they'd rather put more money into their store. If traders don't want it, if investors don't want it on the retail side, they'll take it back. You know, Buffett has that attitude too. Buffett's like, well, nobody else wants it, I'll buy it. You know, he says that about Berkshire too. Berkshire's trading at 20 times earnings, or actually right now it's probably trading close to 30 times earnings, which is, by the way, one of the reasons I think the whole market should be shorted, because Berkshire should never be trading at more than 20 times earnings. But, you know, this is not anything like that. This is 10-something times earnings when you're getting 2% in the bank. The Fed just cut, you're going to get less in the bank now. These guys pay a 5% dividend. Trading 10 times earnings, paying a 5% dividend. I don't even like this stock, and it's freaking, I mean, this is great though, because I like Macy's better. Macy's trades at 6.5 times earnings and pays a 7% dividend. That's why I like Macy's better. And also, I like Macy's because they own, first of all, just the store in Manhattan alone justifies this valuation. Just their Manhattan real estate is worth this. So obviously they have debts and so on and so forth, but the bottom line is that they have to liquidate. They've got that store, they've got stores all around America, hundreds of stores all around America that they totally own. They own the land, they own the parking lots, and all that stuff around. It's worth a ton of money. All right, Sears already proved that stuff's worth a lot of money. Eddie stole the stuff in Sears. He kept it for himself and ripped off the shareholders, but hopefully Macy's won't do that to their shareholders. So, you know, so unless somebody comes in, unless another shark comes in and breaks up Macy's and steals a little money the way Eddie Lampert did in Sears, hopefully they'll be actually worth it. And that, by the way, is why nobody believes in Macy's, because of what happened with Sears. Everybody's like, well, Sears ended up going bankrupt and wasn't worth shit. But that's not true, because there's a thing called is it called ESL? No. Seritage. SRG? Yes. This thing. This is $2.5 billion of assets that Eddie Lampert siphoned off from Sears in another company called Seritage that he owns. And that's what happened to all the Sears money. It's really, really sick. Oh, you can't tell because of he's not a key executive. Isn't that funny? So they have these 198 wholly owned properties and 27 joint venture properties with 36 million feet of real estate. These are all Sears stores. Oh, look, even says the company is formed to unlock the underlying real estate value of a high quality retail portfolio it acquired for no money, basically, from Sears Holdings in July of 2015. And then what they kept doing is they kept lending money, even though Sears is bankrupt, they kept lending money to Sears using certain stores, their best stores, their highest profile stores, as assets. And then when Sears couldn't pay it back, they would seize the store for incredibly, like 10 cents on a dollar, like bankruptcy kind of prices. So what they did to Sears is they picked off their 200 best out of 1,000+ stores. They picked off their 200 best stores and got them before the bankruptcy court could liquidate it. Now, if the bankruptcy court had liquidated the whole thing, the $2.4 billion in value here would have gone back to the Sears shareholders. But because they pulled it out ahead of the bankruptcy, They kept the $2.4 billion worth of stores, and the Sears shareholders got completely screwed. That's what happened to Sears. That's an amazing thing that just exists. Yeah, and I was documenting it the whole time. The whole time, from the minute he started doing it, I mean, you can see me screaming about this stuff and say, how can they let this happen? And how do people allow this? And who's watching this thing? And where is the SEC? Nobody gives a shit. What this kind of stuff goes on in this country all the time. It's just stunning. But this was the most blatant ripoff. I mean, if I had the time, I'd write a book about this because it was the most flagrant, blatant ripoff of shareholders in the history of the stock market. It's just right in people's faces. He's doing it right out in the open, and nobody cares. And he let Sears die because all it was a way to steal $2.5 billion worth of their stores. He never cared about saving it. He never had any intention of saving Sears. You can tell by the fact that it was the way that they never did anything to improve the stores. They never tried anything. They never made any moves to help the company. You just let it die. Step by step by step, they let it die. And the thing is, when Ed Lambert first got into Sears, he could have made more money liquidating it then, but the problem is you can't just liquidate Sears. It was an American institution. Now it's not considered that. Now it's considered a sad old retail store. But at the time, 15 years ago, Sears was an American institution. You couldn't just come in there and break it up and fire everybody. People would have freaked out. Now you blame Amazon and say, yeah, it's Amazon's fault, we're dead. But meanwhile, he starts a whole other company to pick up their assets. It's incredible. It's just an amazing thing that happened. And it happened, it's still happening, and nobody stopped it. Nobody cares. You just have to give up sometimes, you know. You have to say, this is just how the world works. Unfortunately, this is how the financial world works. Oh, Powell's talking now. Forgot about that. Powell, outlook for the economy remains favorable. That's not what it says in the Fed statement. It says the outlook for the economy is terrifying. That's kind of funny. I don't have the sound on, I don't know what it's saying, but what they want to know now is he looking to lower rates again at the next meeting? And that's the critical thing. And we have to wait for the Q&A session because he's not going to say it. He's not going to willingly divulge it, so we'll see what happens. But not a bad sell-off, no big deal. Things are holding up. Our portfolios are flat, which is all I care about. I mean, we have so much gains for the year already. I just don't want to lose them. I don't care about making money anymore. I just don't want to lose any money. We haven't even had any new trades lately, have we? What's the last top trade we had? For top trades, just go to the top trade alerts. Oh, it was last week. Okay, we picked Ford last week. So Ford was a recent top trade, and that's not doing good at all, so that's fine. And IMAX is doing well. IMAX really popped. Oh, that's from July 8th. So we got a nice 10% pop on IMAX since we picked that. They just had earnings. But Ford was only days ago. July 25th was what? It was last Thursday, so that's nothing. So it was still here though, but so we picked it because it was here. But we were conservative. We sold the 10 puts. Okay, yeah, we're playing it conservatively. We're not being super aggressive. But again, Ford is a nice little company. There's no reason to. What do I say about GE? Oh, should put GE through. Oh, the pension thing. That's right. Oh, that does make GE very interesting. We didn't take it officially for the top trade. But we talked about this, and I said, look, at 1044, you're in good shape. The House is looking at Pension Rehabilitation Administration, which would provide long-term pension plans for companies facing insolvency, not the company being insolvent, but the pension plan being insolvent. GE is like the worst pension offender of all companies. In fact, oh, here it is. So this is the kind of discussions we have in member chat, right? Because we start, if somebody brings something up, Mike brought something up. In fact, he's the one that posted this part about the pension rehabilitation scheme. And I said, that's great. We can sweep things under the rug. This is great for GE because their pension obligations are what's keeping the company down. They made $2.5 billion last quarter, and you can buy the company for 91. So if they made $10 billion a year, and you can buy the company for $91 billion, so they're trading at a PE of 9, and somebody is helping them bail out their pension obligation. GE's pension obligation is, they have $90 billion of obligations. They have $63 billion in assets. This is why this whole thing is bullshit, though, for them. So their shortfall is $27 billion. Now, this is a company that makes $10 billion a year. And their pension plan is $27 billion underfunded. But they don't need all that money now. The way they figure a pension is underfunded is they say, well, here's how much you promised to your employees, and here's their probable lifespan, and here's how much they're going to draw down over the next 20 years, and here's how much money you have put aside currently for it. And that means you should have put aside $27 billion more over the past couple of decades, but you didn't. You put aside less money than you need to cover it. But GE is not going to cease operations. And that's what they mean, though. They say if you went bankrupt today, what would happen? Your pension would be 27. You would be screwing your pensioners out of $27 billion, which is 1/3 of their total pension. That's an underfunded pension. You've got no way to cover that if you go bankrupt. But if you don't go bankrupt, all you have to do is put $3 billion a year in. Now, obviously, somebody looks at that and says, well, that means over the next 10 years, if they want to fix their pension, they've got to put aside $3 billion a year to fund their pension plan. So therefore, you look at GE's forward earnings of $10 billion a year and cut it down to $7 billion a year, and now all of a sudden the $90 billion goes from a PE of 10 to a PE of 12 or 13. And that's where this logic is in keeping GE down, is because you're saying, well, okay, sure, they're a fantastic company, they make $10 billion a year, they're growing their business and so on and so forth, but they got this pension obligation. And you can't get around that, but you can. And now the government is saying, you know what, we might actually set up a fund to bail you out. And here's the thing, if the fund is allowing you to pay back, does it say 30 years? If the fund is giving you 30 years and all GE has to do is set aside $1 billion a year instead of $3 billion a year to pay off the their pension obligation shortfall, all of a sudden, boom, problem solved. And now you only have to take a 10% hit on GE's valuation, not a 30% hit on GE's valuation. That's how you got to look at this. So GE technically is back in play, and that's why I made it. But this wasn't about GE. I just was mentioning that this is how our chat room works. Mike said that. I put the dots together and said, look, okay, well, this is good because of this, and here's how much they owe. And here's other companies we should be looking at who are also going to benefit. But the question is, what happened to this? I don't think that's a link. Is it a link? It should be a link. Yeah, sure it is. Okay, here it is. So there we look at the rehabilitation, blah, blah, blah. Introduced committee reports. The Senate got the bill, and it passed the House, didn't pass the Senate yet, but it hasn't been rejected either. So it's still waiting for it to go to the Senate. That's where we are with this thing. So you see how much fun that is? You can follow through on these things and see what's going on. If this thing passes the Senate and the president signs it, I'm just a bill sitting here on Capitol Hill. So if the bill gets through the process and becomes a law, which is right there. Oh, that's funny. I remember that from God knows when. So if the blah, blah, blah. So if the bill goes through the House and the Senate and the president signs it and it becomes a law and everything's hunky-dory, then all of a sudden you've got to start looking at, whoops, what happened here? Where's me? Where's Phil Stockworld? Oh, I see. Okay, anyway, so that's what happened. So do we get to the Senate? And if we pass this thing into law, then you can look at this. Now, so the question is, even so though, if you look at GE now and say, look at the value of GE here, and I said that here, I said 1044 for GE is still a good price. So I'm even with this obligation, I'm willing to pay 1044 for GE. You look at the other ones, are these guys worth it? So the bailout would be a huge bonus. Boeing, we're still waiting for them to hit 300. How are they? Okay, so I'm hoping Boeing hits 300. I want to jump in there. But again, Boeing also a huge benefit from the pension bailout if it happens. We don't know what's going to happen because the Senate and the House aren't always eye to eye on these things. What you really want to look for is how many Republicans voted on the bill, but we won't get into that nitty gritty right this minute. Oh dear, the Dow's full. Oh no, so Powell is not doing a good job of reassuring people because the Dow's down a lot more now. But anyway, so I really like that. So somebody should remind me of this thing because this is a big deal to go through all these guys. Ford is another one. We like them anyway. IBM we like anyway. Because what's $10 billion to IBM? It's nothing. IBM's got much more money than that. Lockheed Martin's another one. Now Lockheed Martin's huge benefit. These are a lot of these stocks we like. There's Boeing. Boeing we don't have. GM we kind of like. Exxon I think we have a little something in Exxon. T we always play T. Lockheed we have. Delta we like Delta, but I don't think we're playing them. IBM's our stock of the year, so we certainly like them. DuPont we're not playing. Ford we have. UPS we're not playing. Dow now we're getting out of it. All right, but a lot of these stocks, we like them despite this stuff. Caterpillar we've got. That's it. Okay, so I have that list. So we have a lot of the guys on this list already. We want to look at some of the other ones there. Are you guys being unfairly beaten down over this stuff? Pfizer we certainly like. Procter & Gamble, no. Procter & Gamble have too many problems. But so things like that, you got to pay attention to the news. And that's the great thing about our chat room is we have a lot of people paying attention to the market and they see a lot of different things and they bring something up and we talk about it and we discuss it and we figure out a way to play it. That's the key to this whole thing. I mean, that's what Goldman Sachs does. The whole concept of a big fund like Goldman Sachs is to have a lot of researchers and analysts, whatever, all in the room sharing ideas. But the reality is they don't share ideas because they pigeonhole people too much. They put people on a certain desk. You're on the commodities desk, and you only should look at commodities. And you're on this desk, and you're on the auto desk. You only care about autos. And they don't talk to each other, and they don't cross-communicate, and they don't share ideas. And that's not good because you never know when something like this will affect multiple things. Which will the analyst go to every single one of these desks and talk to all of these people and start talking about stories and things? No, it doesn't work like that. That's the problem with these things. These guys, the guy who's at the commodity desk or the guy who's looking at the General Electric who's got that ticker to watch, this isn't something he's going to be watching. We take a multidisciplinary approach to fundamentals, and that's good. We are all over the place because we're human beings who read what we want, look at what we want, and during the day, and if we think something's interesting to our group, we will bring it up in the chat room. And that is key. That is really the key to our success. Is things like this is a great example of exactly what works properly at PSW. This is exactly what makes it great when you have things like this. So I want to thank Mike for bringing that to our attention. And I'll thank whoever reminds me of all this later that we need to keep following this and move forward as it goes through the motions. What else? Okay, that's it. So Powell is speaking. The market is crashing now officially. Very nice. Getting good motion down here. So good gains on this one. On the short, wow, look at the NASDAQ. Holy crap. Oh, so much for 3,000. That's gone. 27 gone. What can you do? Rate cut is mid policy. What is Powell saying that's pissing people off so much? Let's find out. Twitter gonna know? Twitter has been disappointing. Powell. We are not in any way criticizing trade, always criticizing trade policies. When you know, he's saying we're not criticizing trade policies, so he's criticizing trade policy. Oh, good, stream text, very nice. Okay, let's see how we do. Okay, this is not streaming text. Do people don't know what streaming text means? And in what world is that? Is that? Oh no! Stop! I wasn't trying to do that. Sorry, Twitter. Current monetary policy is trying to address global downside risks. Powell Cordita ante baja los tripos blah blah. God, I do not know that language. What is that? The Spanish? Can't be Spanish. No. Baja los tipos de interés. I don't know. Is that Spanish? Yeah, ES is Spain, right? This is SpainInvesting.com. Oh, that's not. I don't know what that is. We don't know what he's saying. Why do we? I guess yeah, it's Powell in any language, right? So yeah. So you say Powell, it's going to bring up Powell if they're talking about him in a foreign country. There isn't a lot of experience responding to global trade tensions. That is something we haven't faced, and we're learning by doing. Oh, well, yeah, that's not really encouraging my confidence. Powell says they'll be looking at the risks includes U.S.-China trade war. See, and the trade war, don't forget, again, I mentioned this first thing in the morning, that the trade war is in no way resolved. It's, in fact, it was, let's talk about that for a second. These guys, Mnuchin and Lighthizer, okay, and don't forget, Lighthizer is an anti-China psychopath. And to make him a trade representative in the first place is a complete insult to China. And to send Mnuchin, who's got zero experience as a negotiator and no foreign policy experience or anything, he's a freaking banker. To send a banker and a China hater to China to discuss trade negotiations with top-level trade negotiators from China who spend their whole life doing this stuff, it's insulting. I don't understand why people don't see that, or just they refuse to talk about it or whatever, but we are insulting the Chinese by the very nature of the way we're negotiating with them. And this is bullshit. They fly in, they don't have any niceties. They fly in on a plane. Last night, they had dinner with the Chinese, but that's, just a perfunctory, dinner thing. But they had a dinner with the Chinese, and today they have 1 4-hour meeting, and they get right back on their plane and leave because the meeting broke up and they weren't agreeing. So they said, forget it, bye. And this is how Trump instructs them to trade, because he says if you don't get concessions, that's it, we're out. But, and again, my broad theory on this is that Trump doesn't want to make a trade deal with China. He wants to keep collecting the tariff money, because the tariff money is like a gigantic slush fund for Trump. Billions, hundreds of billions of dollars of slush money that he's treating like he can discretionarily spend it, like the way he's handing it out to farmers right now. He just took $18 billion of the tariff money as if it's like a piggy bank he gets to go into, and he's now redistributing it out to farmers, basically trying to buy votes. But the way he's doing it is the way he does everything, where he's giving all the money to the top 1% farmers and basically no money, $5,000 per farmer, to people to the bottom, I think it was the bottom 80%. Might have been worse. Hang on, let's see what the number was. I mean, I'm pulling these numbers out of my asses. Yeah, the bottom 80% of the farmers got less than $5,000 each. 82 farmers out of 563,000 farmers. So who's that? The top 1/100th of 1%. Not 1/10 of 1%, the top 1/100th of 1%, which is Trump, basically, that's his bracket. These guys, 82 out of 563,000 farmers, wait. Where was that number? Oh, I think I messed it up. I think I didn't report that correctly in the thing. I didn't write it down. I think I forgot to. I think I was checking the number and forgot what I was doing. So the 82 farmers got 500,000 or more out of that many. Oh wow, I can't believe I botched that up. Yeah, wow. I forgot what I was going to say here. 82 out of 500,000 farmers got $500,000 or more. 80%, so 400,000 something farmers got less than 5,000 each. Only 82 people got $500,000. $5,000 is not making a dent in the damage that he's done to these farmers. What he's doing is he's redistributing the money that he stripped away from these 400,000 farmers, and he's handing it to the top 82 farmers, because you know what? The top 82 farmers write him big checks to get him elected or re-elected. Okay, we don't living in a real. I'm sorry if I bitch. Oh, frick! The Dow's like plummeting now. What the hell is Powell saying? This cut is different from the start of. Oh, Powell said this is not the beginning of a cutting cycle. He said this is like a one-time cut. People are freaking out. So anyway, so, you know, I'm sorry if I bitch about Trump and come across as anti-Trump, but this is a freaking, I mean, this is, what do you say about a guy who's ripping off Americans? He's taking money from a vast majority of the farmers and giving it to 80 farmers he likes. What do you want me to say? God bless Donald Trump? He's a thief, he's a crook, he's a horrible person. He's destroying this country. And I said that here. He's cost us $4.5 trillion of additional debts and costs and such. And that's not even counting the damage he's done from the trade war. That's not even counting the damage he's doing to the environment. That's just the cash money out of our pocket that we have in debts that we've accrued under Donald Trump in 2.5 years. Adding 10% to our total national debt in each year for 2 years. That's what's happening right now. 2 more years from now, we're going to be another $3 trillion plus in debt. I'm sorry, 2 years, 1.5 years from now. We'll be, oh my God. The market's down like 500 points now. Wow. Wow, that's all Powell had to say, is that this is not the beginning of a long-term cutting cycle. Holy crap. All right, well, I told you Short Russell was a good move. It's actually not the best loser so far, but it will be. It's gonna really get hit hard now. And look at that, look at the dollar blasting up. This is not the beginning of a long-term loosening cycle. Boom, up goes the dollar. Even Apple got hit on this one. Holy crap. Apple lost $8. Silver falling to the floor, because this is dollar oriented. So this might be a chance to go back into silver and back into gold when it calms down. You know, oil's taking a hit, everything's taking a hit because the dollar's just blasting higher. That's a huge move for one day in the dollar, 0.5 point. I don't know where we're going to calm down. This is all obviously overreaction, but the bottom line is, you know, nobody wants to hear that this is a one and done rate cut. That's not at all what they're asking for. So Powell is not giving the answers that people want. So, oh, that makes it real. We knew it was going to be exciting, right? And that's why I wanted to park the portfolios in neutral, though. I don't want to. Who wants to deal with this? Why should I want to be worried about this crap? So we're nicely neutral. We'll make our adjustments when things calm down as we get through earnings season and so on and so forth. But like I was saying before we got off on that tangent with the top trades and stuff, that's what we're doing. That's why we haven't put out too many trade alerts. We're not doing too many changes. We're just riding this out. We got ourselves into a nice, we adjusted and adjusted and adjusted, got ourselves into a nice neutral position, and now we're dealing with the news, dealing with the up and down market, right? Because it just went down 500 and up 200. Now we're only down 300. Just 10 seconds ago, we were down 200 more points. It just popped back up while we were looking at it. You know, it'll settle where it settles. And this is the thing. If you trade and if you know how to balance your trading and balance your portfolios, this stuff doesn't bother you. We can sit back, relax, and watch it. And when the time is right, we'll make our adjustments. We are not under pressure. And we have lists of stocks that we like. We have trade ideas that we like, and we can go back and see who got much cheaper, which one actually fell off a lot because of earnings, because of the Fed, because of so on and so forth, and which ones do we feel are going to reverse and come back for us. So that's the way we're going to look at this stuff. I'm just going to see if there's any more questions before I sign off. So hang on. Oh, okay. Leapster says, doesn't the pension plan have to be less than 40% funded to be eligible for the bailout? I do not know. I didn't read the whole thing. So I don't know if that's the case, and if that is the case, we have to take that into account. But like I said, I wouldn't even go by whatever's written now. You want to see what comes out of the Senate after they mark it up and what gets approved and what gets signed. Then we have to go back and make our things. So I just said, all I'm saying is it's interesting to watch it for that now, and if the bill gets passed, we'll see what happens. AF said the market is collapsing. Thanks for pointing that out, although I wasn't looking at the questions at the time. 1020 said he's a crook, which I assume is Trump. I'm waiting for him to make that I'm not a crook speech. He needs to do that. He needs to go full Nixon. Phil Weiss, gold down so much isn't supposed to be defensive. Yeah, it's defensive, but the dollar rules gold. So if the dollar's really popping, that's going to push down gold. Usually you'll get like a 2-to-1 move. So if the dollar's up a half a point, gold's going to go down 1%. But also, you've got Powell now saying that we're not going to weaken the dollar, and there is no inflation. So we are fighting inflation. We're not going to weaken the dollar, and that then means why are you putting money into gold? How is it going to be defensive inflation? So again, I don't think that's going to kill gold. I just think that there's no reason for gold to be flying up to 1,500 given what's going on today. So you know, gold is not. Gold is an inflation hedge to some extent, but not like it used to be. It's just not a big enough part of the economy. I think somebody said all the gold in the world, if you took it all together, it's about $4 trillion worth of gold. That's all the gold in the world, it's just $4 trillion. And you'd say, oh, well, in that case, shouldn't it be you know, worth a lot more? No, you know, it's really not used as money anymore. So it doesn't have that much value. It's a value as decoration. You know, it's psychologically, you think it's a hedge, but it's no more of a hedge than Bitcoin is really. Gold is a thing that you place value on because you bought it and because somebody else might buy it from you. But in itself, it has no actual value. It's a shiny bit of metal. It has a demand value in that people might want it for things, but that demand value is way, way below where it is now. The demand value for gold is probably about $900,000. So the other 4,000 is already the implied hedging value. But gold is not the only hedge available to you these days. You know, there are all kinds of derivative hedges that you can have. You know, it's a very old-fashioned thing that gold is an ultimate hedge, and I know, and that's a problem. I mean, a lot of us. I went to school. I didn't want to think about it. I went to school 40 freaking years ago. Is that true? What year is this? 2020, 19, 35 years ago, whatever. So I went to school 35 years ago. It's a long time. It's like, you know, like double my daughter's lifetime ago. So at the time, I was taught these things, and most of you guys were taught these things in school. You go to a fancy school, you got your diploma from Wharton or whatever, and you come out of school and they told you that gold is an ultimate hedge and that gold is an inflationary hedge and blah, blah, blah. It's not true anymore. That's the way you just got to let it go. Gold has value as a industrial metal. Gold is a rare commodity. It is difficult to replace. It can't be, look at diamonds. Diamonds are getting destroyed because diamonds are now, you can make diamonds. They're making diamonds every day. They have machines pounding out diamonds now. And obviously the diamond people are going to say, those aren't diamonds. I don't give a shit what, how do you say it's not a diamond? It's a diamond. Every quality of it is a diamond. It's not only a diamond, it's a more perfect diamond than diamonds. It is a crystalline structure that is all the qualities of a diamond. It's a diamond. It is a diamond. I mean, they're just trying to basically copyright the name and say you can't call it a diamond if it's artificial, but that's bullshit. They're passing. I mean, they're running around like crazy trying to find ways to differentiate an artificial diamond from a real diamond. But other than the word artificial, that it was manufactured instead of real, it's a diamond. We can make diamonds now. We can actually make a diamond. A diamond is actually better than a diamond you're likely to find in the ground. We make it out of carbon under pressure and heat, and it comes out, and the machine does whatever it does. It's like Superman going and pushing and making a diamond. There's a machine now that does that, and it makes perfect little diamonds with no flaws, and it's killing the diamond industry. But you can't do that with gold yet. You will be able to in the future. There's two problems for gold. In the far future, there's two major problems for gold. Problem number one is we are going to basically conquer alchemy. You'll be able to 3D print molecules and make whatever you want. So we will be able to actually produce anything we need materially, which is great. I mean, that's not immediate future, but within 100 years, yeah, we'll be able to make anything we want. You'll be able to take material, break material down, and then take those atoms and rearrange them and make molecules and make whatever you want. And they'll be able to change the atoms too, so it'll all be movable. Everything will be fixable. That's problem number one for gold. Problem number two, which is probably a more immediate problem for gold, is that there are asteroids in the asteroid belt that have more gold than there is in the world. There's more gold in these asteroids than there is on the planet Earth, and we can go get them right now. And frankly, if they do go get them, I'd be really worried. We don't have the technology yet, but conceptually, you can go get an asteroid. You can go put a couple of rockets on it, steer it to Earth. Now, you don't want to really steer it into the Earth, and that's where the danger is, obviously, because a big gold asteroid hitting the Earth would destroy a huge chunk of land. But if you could safely park it in orbit and then start mining it and bringing it down to Earth and whatever, you would have more gold than there is in the world right now, and that would devalue gold tremendously, and many other metals. They'll be able to pick asteroids that have what they need and grab them and get them. And we are probably 50 years away from that. And obviously, there's no reason not to buy gold now, but you have to realize a lot of these things that we're going to be able to conquer it. Same thing goes for energy. The problem with the energy market is within 20 years, we're probably going to have fusion. And once we have fusion, all energy needs are irrelevant, including solar. If you have fusion, you don't need solar. Solar is fine if you don't have a fusion reactor around, but a fusion reactor, in theory, should not be that complicated of a thing to have. These are all just engineering problems that we're working on to fix. And they're going to make, very positive, drastic changes to the world. And so I'm very optimistic about the world in general if we can get through the next 100 years. But the next 100 years are going to be very tricky, and especially the next 50 years, because we've wrecked the environment. And we don't have the resources to fix it right now. So, it's that's the biggest problem we have is that. And everything else I think we can probably deal with, but that's our big problem right now, is we have to fix the environment before we do anything else. Hal says, no reason why expansion can't continue. Boy, he's all over the place, huh? So he thinks the economy is in good shape. There's no reason the things. And, I'm not saying the Fed will only cut rates once. Rally, quick, rally. Isn't it good to be neutral? It's like, I don't give a crap what he says. Oh my God. Isn't that insane? So he says there's no plans for a series of rate cuts, but I'm not saying we're one and done. He's not contradicting what he said before. Overall, their outlook for the economy remains favorable. Very funny stuff. Job growth will be slower than last year this year. Okay, so that's where we are. All right, guys, it's been fun. We're a little over time, so I'm gonna have to cut it down. We'll just see where things settle. We'll get back to things later, and obviously tomorrow we'll dissect it and figure out what's happening. But I don't think this is that damaging. Like I said, look, we need a correction. And I didn't think that this is going to support anything, but we're going to have to end up going down, whatever the reason, whatever the excuse is. For some reason, we're going to end up going lower, and I'm fine with that. Though I think it's a good health. It's time for a good, healthy correction. Let's hope we get it. I'd rather get it than avoid it. All right, so we'll see you again next week, guys. Thanks a lot.